Hey, Steven Speck, one of the managing partners here at Rust Bowl Capital. I wanted to jump on today and just make a quick video where we're comparing the returns of the stock market versus uh, real estate, especially private funds, kind of what we offer here at Rust Bowl Capital. And I thought this would be very, very helpful to do. Now, there's 3 or 4 different areas that we could compare the stock market to real estate, but in this video specifically, we're going to talk about appreciation. Now, appreciation is, for the most part, what most people think of when they think of where their gains are coming from when they're going to invest, specifically when they're going to invest in the stock market. And when I speak of the stock market, I'm talking about the S&P 500, which is the 500 largest companies or publicly traded companies in the United States. To buy this index, you would go buy an ETF, an exchange traded fund. SPY is one that is very, very popular to buy the S&P 500. Um, but let's talk about that appreciation idea. So what exactly is appreciation? Appreciation is buying an asset for one price and hoping that it goes up in value over a certain period of time to another price at a later date. So an example of this is, say you bought an apple, right? Like an actual eating apple for $1. And then time passes and hopefully you can sell that apple for $1.05. So you bought it for $1, time passed, and hopefully you can buy or sell it for $1.05. In that case, your apple has appreciated 5 cents or 5%. Now, in order for you to realize that 5-cent gain, what do you got to do? You got to sell the apple, right? You can't hold on to the apple. You have to sell the apple in order to realize that appreciation. Now, if we take that concept and we apply that to the S&P 500, what does it look like? Well, here's a couple historical returns. Year to date, so if we compare where the S&P 500 started in January to where it is today in August of 2023, it has appreciated about 16 to 17%. That's pretty good. What about 1 year? 1 year is if we bought it August a year ago to August this year. It's up about 12%, 11, 12%. And then 2 years, if we bought it 2 August ago to today, it's actually hasn't really appreciated at all. It's actually flat or negative 0.5%. And then 5 years, just to round it out, if we bought it 5 years ago, 5 August ago to this August, we'd be up about 50%. Now, those aren't bad returns. Those are actually pretty good returns, being up 50%. I mean, if you invested $100,000 into the S&P 500 5 years ago, you'd have $150,000 today. That's pretty good. But like I said, in order to realize that appreciation, you have to sell the asset, right? The thing I don't like about that is when I learned about investing at a young age, I was always told protect your principal, right? Don't kill the golden goose. The asset where your investment returns are coming from, you don't want to get rid of it. I don't want to get rid of it, right? I'd rather hold on to that. And so that's where we can start making this comparison of real estate to stocks. Now, I told you at the beginning of this video, most private real estate funds don't publish their returns because they aren't required to, okay? So you could go and compare it to a REIT, but I don't think that's a really good comparison. REITs are a little bit of a different beast than actual private real estate investment funds like what we offer at Rust Belt Capital. But what I can tell you is that most syndication funds that invest in real estate, they're kind of generally targeting a 15% rate of compounding. So just to give you an example, the net of inflation rate of compounding of the S&P 500 over the last 5 years is about 7.8%. That's adjusted for inflation. And then I'm giving you a comparison to on real estate that of an objective that private funds have that's not adjusted for inflation. So just keep that in mind, and I'm trying to be very transparent about that. So yeah, real estate is about twice that of what the S&P 500 is. And that's cool in whatever, but really, even if it was the same in terms of return, if if the stock market gave me a 10% return per year and real estate gave me a 10% return per year, I'd still choose real estate over the S&P 500. And there's a very specific reason for that. And that's because when you buy real estate, typically it's a levered investment. That means you're borrowing money to pay for the real estate. So let's give an example of that. If I'm going to go out and buy an apartment complex for $3 million, I'm going to put $1 million down, okay? This is our down payment, $1 million. We're buying a $3 million asset. Where did the other $2 million come from? It comes from the bank, okay? So we borrow $2 million from the bank. And who's paying the interest on this $2 million that we're borrowing? Who's paying the debt back? Well, the real estate's paying the debt back. I'm not paying the debt back. The real estate's paying the debt back. I just had to put the down payment of $1 million down, okay? Cool. Now what? Now, how does the asset appreciate? How does stocks appreciate? Stocks appreciate because the company starts earning more money. Real estate appreciates because the real estate starts generating more money. So if I can go and influence this piece of real estate to make more money, the value goes up, just like a stock in the stock market does. Now, how do I do that? I increase rents. So let's say this $3 million property that I bought has 60 units, okay? And I increase rents by $100 per month on each unit. That's going to produce about $72,000 of new earnings per year on this property. What's that mean in terms of value? Generally, let's say we're in an 8-cap market without getting into too many details here. If we're in an 8-cap market and I generate $72,000 new earnings a year off of this piece of real estate, I've increased the value of this real estate by $900,000 a year. Okay? Now what? How do I get that appreciation back out? Well, I've got a couple options. One way is I could sell it. If I sell the asset, if I sell the real estate, I don't really like doing that. If I sell it, I can defer my taxes with a 1031 exchange. But yes, I get that $900,000 out. I pay the bank back their $2 million. I get my original $1 million investment back, plus the $900,000 of value that I created. Okay, just like the stock market. I had to sell my position. I made a 90% gain. I took my $1 million and turned it into $1.9 million. But what if I could hold on to the asset and get that $900,000 out? That means somebody else continues to pay for the asset or the debt. I get to hold my investment position. I'm not killing the golden goose, that lays the egg. And I get the $900,000. I get to realize that appreciation. How do I do that? Well, I can go back to the bank and say, hey, just like I did to you, we increased rents $100 a month on 60 units. We're in an 8-cap market. I'll explain what that means in a different video. And so they take $72,000, and they look at that and they say, okay, you've increased the earnings of the property by $72,000. That means that's a $1 million gain. The property's appreciated by $1 million. Okay, we'll go back. We'll give you a loan for $2.9 million. Now you might be asking, Stephen, doesn't this increase the risk? The answer is no. Why does it not increase the risk? It doesn't increase the risk because that new $900,000 is getting paid for by that $72,000 of new earnings that we're creating. Okay? So I can get all that money back. I can get the $900,000 of appreciation back by taking a new loan on this property that is getting paid for by the property without increasing any of my risk. And since it's a loan, guess what? That $900,000 of appreciation that I'm realizing, since it's a loan, I don't pay taxes on it. Not until I realize the appreciation, not until I realize the gain on the investment. This is why a 10% per year return in real estate and a 10% return per year in the stock market are not the same thing. And yes, the value of each asset is based on the same thing, which is earnings or cash flow, right? So how do we know right now Microsoft's trading for $328 per share? How do we know that it's worth $328 per share other than some schmuck out there is going to pay $328 for one share of Microsoft? Right? That's a great question. The reason we know that is because that is the cash flow, or that is the value of the cash flows off of the company, Microsoft, today. That's what it's worth per unit of stock of the company. Same thing with real estate. How do we know what real estate's worth? We know what real estate's worth based on the cash flow that the real estate provides. So if we can increase the cash flow of the real estate, we increase the value of the real estate. The advantage we have is we can go borrow against it without actually incurring more risk. And that is why I like real estate. That's why I prefer real estate over the stock market. Can I do this in the stock market? Sure. You can borrow money. It's called leverage, or it's called margin investing when you do it in the stock market. The problem with it is, if we go borrow money to buy Microsoft stock, the theoretical value of Microsoft is quoted every day. So we take on quotation risk, meaning if for some reason the value is quoted at 328 when we buy it, and then 2 days later it's valued at 200, the bank, the person who loaned us the money, can call us up and say, hey, we have an increase in our perceived risk, and therefore we need you to put more margin collateral, more money up, so that our position as a lender to you is secure. Now with real estate, we don't have a quoted price on it every day because it's not publicly traded. That's a good thing. That's our advantage, okay? The second thing is, who's paying the interest? If I borrow money to go buy Microsoft stock, which I can do, it's called margin investing, right? I have to pay the interest on it, okay? The dividend off of Microsoft today is 0.83%. 0.83%. That's not probably going to be enough to pay the interest on the money that I'm borrowing to buy Microsoft stock. That's not cool. I like it when other people are paying my debts for me or for our investors, okay? You should probably like that too. Think about it. Has that ever happened in your life before? Probably. When you were growing up, mom and dad had a house. They probably had a mortgage on it. You got all of the benefits of living in that house, but somebody else was paying for it. Mom and dad were. It's the same thing, other than the tenants aren't necessarily mom and dad. But the tenants are paying for this piece of real estate, and you get all the benefits of it. You get the appreciation. Somebody else is paying down the debt for you. You hold on to a tangible asset, and you get cash flow. Now, I said I wasn't really going to talk about dividends in this video, but I'm going to mention a few things here. When you go to the bank, okay, and you're in retirement, okay, maybe not in retirement, cash flow or dividends are what you're going to live off of, right? Yes, that's what you're going to live off of. And the cash flow you can borrow against. That $900,000 example just a second ago, that was an example of us borrowing against cash flows on the property. When you invest in the stock market, if the dividends are 0.83%, if you're in Microsoft, or if you buy the S&P 500 at large, and it's 1.4% or 1.5%, that's a very small dividend. That flow is really small, and it doesn't really grow. And there's no way for you to grow it or to influence it or anything like that. Real estate there is. Okay, we can enhance the dividend return. Typically, we can get properties up to, or I'll tell you what some dividends are off of my own personal properties, right? 10%. Okay, so if I invest $100,000 into my own property and I can get it to where I'm making 10% per year, I'm making $10,000 a year. Okay, if I invest $1 million, now I'm making $100,000 a year. Okay, $100,000 a year in passive income from $1 million investment. You're like, wow, I got to come up with $1 million. That's where the appreciation game comes in. We're trying to push the appreciation on these properties, collect it, do these refis, and keep building this appreciating asset that actually has the ability to, when we need it to, say, hey, let's turn on the cash flow spigot instead of really worrying heavily about this appreciation as much and just sucking money back out of it. And then we can get that cash flow coming out of it. Cash flow you can take to the bank, you can live off of, you can borrow money against, pays for stuff, pays for vacations, pays for mortgages in Hawaii or houses in wherever the heck you want. Like, those are some things that I would be thinking about. Those are things that I think about personally as an investor. And anyways, a little bit off topic. I'm running over time here. Hopefully this video provided some value to you. If it did, please like, share, subscribe. Give me a comment in the comments below. Tell me what I can improve. Tell me what questions you have, and I'll try and answer them for you. Thanks.